Okay, so let us call the Joint Retirement Investment Board special meeting to order at 7:04 p.m. And the agenda this evening is brief and to the point. BlackRock is going to give us an extremely brief, I mean like 30-second update on performance, because we don't want you bragging for something you're not responsible for. And then we'll let you guys give us a presentation on the matter at hand, which is the private equity discussion. Turn it over to you, Josh.
Yep, I'll keep this brief. I'll say we did shepherd you through a strategic asset allocation review that has affirmed the great returns. Hopefully, prospectively. I know we're looking retrospectively here, but I'll keep this relatively brief here, and then bring in Carolyn. Page 4 of our materials covers the June performance update, and I know I was with you all basically a week before the month and quarter and your fiscal year wrapped, so not so much significantly changed other than some index rebalancing that happened on June 26th. But for the fiscal year performance, or maybe we'll just cover the quarter performance in that first column, super strong recovery after the March initial start of the war in Iran, where we saw massive drawdowns in equities in March. That significant recovery that we talked about all second quarter printed for the pension portfolio up 8.2% the quarter, which puts in a fiscal year-to-date performance of almost 15.2%. Again, that's against the actuarial discount rate benchmark of 6.9. So significant outperformance for the fiscal year. We'll show some further historic numbers, but you're above that actuarial number on a number of historic periods as well.
So Josh, since we're on a July 1 to June 3rd, this is our fiscal year returns.
That is correct.
Okay.
Yep. And then for the OPEB, given the higher equity allocation, we've talked in the past again about the differences in the private equity exposure as well, with OPEB only having HarborVest is another difference in some of the returns. But the higher equity posture in OPEB, given the equity rally in this last quarter, right? The OPEB portfolio return almost 10.5% for the quarter, 19.2% for the fiscal year. Again, both have the 6.9% target discount rate. The returns primarily driven by the strong equity recovery. You'll see your kind of fiscal year to date or 1 year basis equity returns at 25%. Pretty substantial. This is again the third straight year that at least the fund has seen double digit and nearly 20 or 25% returns. So strong performance on the equity side. Fixed income, with rates elevated where they are, rates kind of staying relatively range bound, some volatility in rates just given inflation fears, the war in Iran, that's impacting globally. But this has been a real big income year. So fixed income for the year at about 3.5%, reflects there was a bit elevation in rates both in the U.S. and globally, which would be detracting from the overall income. But when you're looking at the 30-year Treasury at 5.2 or so, and the 10-year at 4.6, it's a nice income that you can clip to offset any impacts on the equity side here. But all in, just great, phenomenal fiscal year again. For the pension itself, if we turn to page 6, if we look down at the bottom there, just on the green bars going back historically, so your fiscal year almost 15.2%. On a 3-year basis, that's 12.2%. Even on a 5-year basis, right, that includes 2022, the massive equity sell-off and the rise in rates that kind of hit fixed income, at almost 6.7. Again, comparing to your expected return discount rate of 6.9. Very strong results, kind of keeping in line with what you're hoping to do. If you all remember, and this is the first report that you'll see, we discussed a policy benchmark a couple of meetings ago. That's for the pension plan. You're investing relative to a 65% global equities, 35% ag number. You'll notice that it's a bit underwater relative to the current portfolio over the near term time periods. Again, that the biggest drivers of that is the fact that the private markets portfolios, both private equity and real estate, have detracted relative to both public equities and fixed income. So the public market side, especially over the last 2 or 3 years, has been, the place of higher returns than private markets. But if we look historically, it's a bit more in line with that policy benchmark. So it's one of the things on the pension. We'll notice it's a bit better performance on the OPEB side, and some of that drag, like I said, is some of this legacy, the Lexington and Mesereau PE that has dragged just a little bit in the last couple of years.
Josh, can I just interrupt you with a quick question? And maybe this might even be something for Caroline. Is it Caroline or Carolyn? I apologize, I don't know which it is.
Sorry, Caroline, I was trying to unmute.
Oh, very good. Thank you. And this is something that we always talk about. I'm just curious, our fiscal year-to-date numbers in the alternatives, are those actual or are those estimated? Because we're always talking about the delays and all that kind of stuff that frustrates us terribly in that sector.
Yeah, so if we look back to page 4, right, you'll see the fiscal year-to-date PE numbers. The most recent prints that we have are 331 numbers. So this does include the fact that almost all of your PE funds printed a negative quarter to end March 31st. There was a bit of a drawdown, but the prior quarters have been relatively positive. I think if we look at the fiscal year numbers on those, they'll be mostly positive for the fiscal year, but you kind of cut it at 331 and don't include this last quarter rally. We'll get those updated statements towards the end of the summer.
Okay.
We'll turn quickly. 7 and 8 is the breakdown of all the funds. Again, the liquid portfolio, entirely passive. So if we look at the green bar at the top of page 7, that's the liquid portfolio against the liquid indexes. The tracking error should be basically 0 here. You'll note that on the 3-month, there's a slight negative, quote, active return on the liquid portfolio. We discussed this in the April meeting, but that's your international iShares, right, that had that weird positive alpha in March because the price in the US on the iShares captured the start of the rally at the end of March. So you actually captured some of that excess performance in March in the last quarter's report. And so you'll go down about halfway down the page, you'll see the iShares International Equity ETF has a negative 2% active return for this quarter. And again, it's because of the price discovery. The international index close at their local times, but the iShares trades until 4 p.m. New York time. So you get that rally, and there was an excess performance that was captured at March 31st. But if we look at the fiscal year to date in longer periods, there's basically no tracking error at the total portfolio level. There's some modest tracking error on the international equities. And again, that's just given that the funds trade until close in New York versus the index that closes, 12 hours earlier for some of the EM, almost 18 hours earlier. So, but all of this is operating as we expected. If we turn to page 9, this is the historic breakout again of the pension portfolio. Nothing especially new or concerning to talk about on this page, other than how it feeds into the total portfolio. We talk about that private equity line on the pension fund has struggled a bit more in the recent side. That's some of the older legacy vintages that haven't been able to exit some of the positions. We've seen a slowdown in some of their returns. Whereas if we flip this to the OPEB, you'll see about 300 basis points better PE return, and that's just because HarborVest has had a better, more recent experience in terms of returns and monetizing some of their early investments versus some of the legacy holdings of the older PE. But the long-term PE exposure here, 10-year annualized return of almost 17%, dwarfs your public equity side. So again, staying allocated here over the long term, we continue to see the benefits of staying invested here. Notwithstanding the more recent struggles in the PE versus the public equity markets. And then last but not least, on the private market side, I do want to give an update of kind of the cash flow that we have. So on page 10, this is our committed capital, the capital called and the NAVs. Lots of numbers here, but I'll just highlight, we did have about $4 million in capital calls this quarter. So you'll notice the difference between the capital calls at valuation date of total called has been 63.8 million in the program. As of June 30th, that was 67.9 million. All of those to the HarborVest funds. We did also receive distributions for the quarter. We received about 2.3 million in distributions over the quarter, which were then used to fund these capital calls. You'll notice that the 2.3 million isn't the same size as the capital calls, so we drew down some of that alternatives proxy, right? We allocate to public equities as part of this private equity program, and when we need capital calls that aren't covered by distributions, we draw from there rather than the liquid portfolio. So we drew down about 2.3 million. We drew down about 2.5 million from the proxy in May for the HarborVest capital calls. Fiscal year to date, just to close the loop here, we received about 8.3 million in distributions from the private equity program. So continuing to receive some cash flows, especially from the Mesirow funds and a little bit from the Lexington funds. We made almost 10.1 million in capital calls for the fiscal year. So net, even though we withdrew about 2.5 million from the proxy in May, we had invested a little bit back into it with some of the excess distributions that we received earlier in the year. We paid about 1.8 million net from the proxy to fund the fiscal year capital calls. I'll pause there if there's any questions. I could do a quick rundown on the private market side of the OPEB if you're interested, and then we can hop over to Caroline.
I think unless anybody at the table disagrees, obviously the performance has been terrific, and sarcasm aside, we appreciate the good work you've done for us. We're assuming that there's a actual guarantee that next year will be at least as good or better, right? That's how you guys provide the service.
It always comes. I think our disclosures have that in bold, 24-point font.
Right. So
future results are guaranteed.
We'll hold you to that, or else we'll have Caroline be our new rep. So why don't you guys move into the topic of the night?
Yes, sure. So we have our private equity pacing. I'll just do a very brief summary and then introduce Caroline. Caroline, introduce herself and kind of walk through. But if we flip to page 20, just a summary of how we've gone through this. So we confirmed the strategic asset allocation earlier this year. That set the private equity targets at 10% for both the pension and the OPEB. We walked through some preliminary private equity pacing analysis at the April JRIB, which was really to set the stage of how much do you need to commit. After receiving some updated PE numbers, we updated that analysis in June. We came with a recommendation that you make a commitment for the OPEB, $6 million commitment split 50-50 between the police and fire OPEB and the town employees OPEB, with no commitment from the pension to be revisited for 2027. The implementation of this commitment, again, we recommended, given the size of OPEB, that we focus on fund of funds that allocate across primaries, secondaries, and co-investment, not just a single sub-strategy category. Adam Street was one of the names that is on our highly rated list that Caroline will talk about in a minute. And we recommended Adam Street, the global fund of funds, for the OPEB. Part of why we're bringing Caroline today, there were a couple of questions about, further digging into the due diligence on both Adam Street and just the private equity managers and private equity space in general. So I thought Caroline would be great to provide you a bit of color. How does BlackRock look at these managers? What are we looking for? Why is Adam Street a good manager and a good fit for this portfolio as well? And definitely don't be shy about asking questions. Caroline gets peppered by lots of internal BlackRock client CIO questions from people like myself, so she can stand the heat, and definitely don't be shy. But Caroline, I'll give you the floor to introduce yourself and talk about your process.
Great. Well, nice to meet you all. Caroline Norberg, as Josh mentioned, I'm a member of the BlackRock Manager Research Team, specifically covering alternatives. I've been at BlackRock now doing this for about 9 years, and in some capacity been overseeing and diligencing investments for the last 15 years. I actually spent some time with Joe Quinn at K2 Advisors, so I'm sad to miss him today, but give him my best. But really, this is your time, so feel free to most interesting and most helpful for you all. Talking a little bit about Adam Street and kind of why I like this platform.
Caroline, excuse us just for a second. No, I'm just raising the issue.
I think it's a good fit for this portfolio. I'm happy to take any questions. There are.
One second. Josh, can you see us here?
Yes, I see you. I think Carolyn, you're breaking up a little bit. Maybe cut the video, maybe, and just stay audio might help.
Yeah, she's frozen.
Give me a second. Okay.
Okay.
Give me. Yeah. Okay. Is that better? I can dial in my phone as well.
Yeah.
Sorry about that. One second. Let me do. Okay. Let me know if it breaks up, and I will dial in over my phone.
Yeah, we're not hearing you. I don't know if you can hear us, but
Here, let me just join this from my phone then. Sorry.
Not lately. Not much. No. Little day trips. Business, but a little slow. Like first half last year, just slow. So buy sides at least come on here and sell. Nobody's saying that's looking to sell their company.
time to go play golf.
Yeah, exactly.
Okay, can you all hear me okay now?
Right? Yes, we can. Oh, we see you too.
Okay, well, this is a little bit of a scary view, but that's okay. Sorry, so I'm not sure where I cut off, but I thought I would start just by giving kind of high-level overview of Adam Street, why we like the platform, why we think it's a good fit for their portfolio, and then happy to take any questions on either process or Adam Street.
Maybe Caroline, if you hear me, maybe if you take one step back, because I think I'm going to anticipate questions around the table. If you could talk a bit about fund of fund versus direct investing into, one particular or two particular funds, then discuss Adam Street. I think that might be helpful.
Yep, absolutely. So I think for this portfolio in particular, given the allocation size we are talking about, we think in order to have kind of a diversified portfolio that has, exposure to buyout, secondaries, co-invest, like a well-rounded private equity program, a fund of funds is really kind of the best approach here. We could do single fund, but really you'd be taking an incredible amount of concentration risk. And for the most part, those minimums are about $5 million typically. So you really would end up with one single fund manager, which, obviously is not representative of kind of a diversified private equity portfolio. And results could be extremely volatile. And so I think for the size of the allocation here, we feel like the fund of fund approach makes the most sense. But Josh, I don't know if you have any additional comments.
That's pretty much what we covered last month when we talked about this, right? The fact that the HarborVest private equity allocations are also fund of funds. If you're thinking about we need to allocate to co-investment, for example, to Carolyn's point, a direct manager, you're picking one manager and minimums become a question. So the OPEB fund itself is probably, more representative of why you would want a fund of fund for this size. You're $100 million or $120 million making a $6 million commitment. It's really two plans, right? You're making commitments for both police and fire and the town employees separately. So it's really two $3 million commitments that we're thinking about here. And so the size becomes a factor. And Caroline will talk a little bit more about the fund of funds, but you're going to get access to, dozens of managers, not one single manager.
Okay.
Yeah. From a subscription into one fund that will allocate to many managers? Okay.
Yep, you will sign one subscription document, and then Adam Street will invest on your behalf into, 20 to 30 underlying partnerships.
Okay, great.
Yeah. So there's also the operational efficiency of it, right? So you're not dealing with, 20 to 40 with co-investment secondary line items on your end of things. You're seeing one single line item.
Caroline, my concerns last time, I understand the concentration risk of a single fund, but if you're talking about the fees associated with managing a fund to fund, is it somewhat dilutive there? Does it give some disadvantage?
Yeah, I think the the private equity fund of funds have come a long way in rationalizing those fees. So you'll see buyout, which is the biggest portion of the allocation, actually has no incentive fee attached to it. And then also like the co-invest that you get through the program, Adam Street doesn't pay fees on it, so it's not a double layer of fees from that perspective. There's only one layer of fees because they don't pay fees on co-invest to the underlying GPs. It's more like a relationship-based transaction with their GPs.
Okay.
So I hear you, and the fees are frankly like pretty convoluted, as you could imagine, because there's primaries, secondaries, co-invest. There's actually different fee schedules attached to those three things that then roll up to one single fee. But I have a full spreadsheet that breaks down like the mechanics of the fees that I'm happy to share with you all, so you can get comfortable and kind of wrap your arms around exactly how the fees work in this vehicle.
Love to see that. Yeah.
We appreciate that. Go ahead. Why don't you tell us about this fund that you guys seem to be high on for us?
Yeah, of course. So Adam Street is a $70 billion private equity fund of funds manager, established in 1972. So one of the kind of longest tenured investors in the space. They have about 100 investment professionals across 15 offices globally, who all have deeply ingrained networks and relationships across kind of the GP community, private equity community broadly. So we don't always think that, size, scale is the most important factor, but in the fund of fund space in particular, it's really important. So where we might like opt for, a newer startup in a more niche area of the market, we feel like when you're talking about fund of funds, size and scale is really kind of what they're bringing to the table for you, in terms of being kind of a known entity in the market and being able to access hard to access private equity funds. Their history in the space as kind of a known capital provider gives them access to some of the top tier GPs that frankly are closed to kind of new relationships and new investors. So that kind of tenure in the space and breadth of coverage in the space is really important when we're thinking about kind of the universe of partners we could choose in private equity fund of funds. Adam Street really stands out in having kind of that pedigree and long-standing relationships in the space.
Are they U.S.
From a
Are they US
so they
managers?
15 offices. Sorry.
Are they a U.S. manager and located where?
Yes, so Chicago is their headquarters. That's where the business was kind of founded. But now they do have, global offices, but Chicago is still kind of headquarters for the firm. In terms of kind of alignment, that's obviously a key point when we're also thinking about partners. Adam Street is 100% employee owned, so you have alignment from kind of the employees' equity ownership in the firm. It's very broadly dispersed across the investment professionals of the firm. And additionally, the investment professionals invest alongside investors in each of the funds. So collectively, the employees have about $1 billion invested across various vehicles. So when we're talking about private markets, alignment of interest is always something we're really focused on, and we feel like Adams Street has that in spades. Another kind of key, I guess, item that we think about is employee turnover. They have an extremely tenured team with extremely low turnover. The people that work there enjoy working there. They love kind of eating, breathing private equity all day long. That's all the firm does. They've started to do a little bit of private credit, which I would say is only in the sense that it's heavily related to what they do in private equity. But really, private equity is their DNA. It's all they do. The people who work there, it's kind of been their entire career. And so really high caliber, tenured folks across the board who have been with the firm for a very long time.
In the fund of funds you're talking about, Caroline, is there going to be exposure to the private credit part of
No.
Adams Street? Okay.
Nope. The private credit venture is newer. It just in the last 12 months, it seems like everyone has to do something in private credit. So they have done that as well. But it is a separate team, separate entity. It would not have any allocation here. It's a fairly small sub $1 billion piece of the $70 billion firm today. In terms of kind of performance perspective, you'll see there's a slide in here on performance. Apologies, I can't see the number at the moment. 26. Kind of consistently first and second quartile performer, whether you're looking at IRRs or multiples. The peer group here is other private equity fund of funds. Generally, when you see Adams Street ending up in the second quartile, it's because venture has done really well, and there's only so much venture they're going to put in their commingled vehicles, or large cap has done extremely well. So I think we have been very satisfied from a performance perspective. They've been consistent in their results and delivered, above median returns over the history of the firm. I note the large cap outperformance sometimes skews the way the peer group looks, because you may have read in the materials, they do have kind of a small to mid cap focus. They think that in that area of the market, there's more operational levers to pull with these businesses to generate alpha, as opposed to having to rely on financial leverage. And that's kind of been in the DNA of how they've approached the space since inception. To that point, I do think that makes this a good complement to what you already have on the HarborVest side. HarborVest will invest kind of across the market cap spectrum and leans a little bit more towards large cap. And so this is a nice complement to the existing exposure in that regard.
Caroline, could we go back to page 24, please?
Yep.
I see a range of management fees of 23 to 69 basis points,
Yep.
which is it seems like a pretty large range.
Yep.
And so first of all, I think that's additive to what the GP is charging. And what explains the size of the range?
Yeah.
I read the words there, but it doesn't really jump out at me.
Yeah. So part of that range is the exact mix. So this management fee is a blended average rate that they're showing you. So part of it will be dictated by what's the underlying mix of buyout to secondary to co-invest, because all of those things have slightly different fee rates attached to them. And then the other factor in that range is you will benefit from aggregation from other BlackRock clients. And so, you're allocating $5 million, but we'll have other clients that allocate as well. And so you will benefit from whatever tier. There's different tiers. Once you get to 25 million, 50 million, 100 million, you drop in the fee rate. You'll benefit from the BlackRock aggregation. So that's why the range is there, because that final aggregation is not totally known yet, nor is the exact mix of the underlying buyout secondary co-invest.
All right, so if you just had to hazard a guess, is the logical or the expected fee to be in the middle of the range?
I think what we modeled, and again, I'm happy to share this spreadsheet with you. What we're modeling right now in the spreadsheet is 56 bips.
56.
Yep.
Okay, so just building on that, 56 bips, and then the manager charges a number bigger than that, I assume, as a primary manager, right? Over 100 basis points?
The underlying GPs, meaning?
Yes.
Yes. Yeah, and those will range. We can ask them to provide us. They have a pretty good, for like the 2026 fund now, they have a pretty good idea of what GPs will be in there. So we can ask them for the look through on the underlyings.
Okay. The reason I ask is that we are asked by the Board of Finance, for example, detailed questions, and it'd be nice to make sure that we understand what the compensation structure is like, and the incentive is, we feel like we're making money, so maybe the incentive structure is easy to swallow, but the management fee, it's kind of nice to know what we're getting into.
Do we have a copy of the offering memorandum to look at?
We do, yes, I could share that with you.
Maybe that would be helpful for you all to take a look at that and go through. It should set forth all those details in there as well.
I'm assuming these fees are taken from that, but yes, I totally agree. Yeah. Thank you.
Yeah, happy to share all of the kind of legal documentation with you.
I got a question. Small buyout funds, right? Are they focused on industrial across the board tech versus the Harbor Best was more like obviously the larger ones, right? The KKRs, the Insights, and so forth.
Yeah, I would say they try to take a diversified approach from a sector perspective. So our latest look at, like, say, software exposure, for example, has averaged between 15 to 20% of portfolio exposure, but they're diversified from a sector perspective. We happen to just look at software because obviously that's an area in focus at the moment, but they will be diversified by sector. There'll be some generalist funds as well as some specialist funds. So the tech funds tend to be sector specialists, but there also will be generalist funds in there as well.
So the international part, is it developed international? Is it EM combination? Asia, Europe?
Yeah, it's largely developed international.
Caroline, go ahead with what you want to tell us about it. I don't want to knock you too much off your stride.
Sorry, my phone is breaking up again.
Okay.
Yeah, no worries. Sorry, I'm pulling up my presentation again. So I guess key points. What we like about Adams Street: tenured platform with a deep bench of experienced investment professionals, deeply ingrained relationships across the private equity landscape. They have 450 active relationships with underlying GPs. They sit on 600 advisory boards. So they are very much in the market and a key partner to many key private equity firms. From a performance perspective, they've achieved what they've set out to achieve to a large degree. First and second quartile. Importantly, never lost money in a single one of their funds. They've had some disappointing years, as you can imagine. 2008, post-COVID, not being the best vintages, but they've done a good job of protecting capital, even when the market environment has not been as productive for private equity in general. So overall, we think it's a really well-run business, really thoughtful investment professionals. They've stuck to their knitting and done what they've said they're going to do over the last, 40 years. and just have a high opinion of them all around. We have had a partnership with them for the last 10 years. So we also have the knowledge of kind of how they treat investors year in and year out, and the type of partners they are in different market environments, and the type of transparency we can get from them when things are more challenging. And so we've been really happy with them as a partner, always super transparent, always providing, anything and everything we need in terms of information about the portfolios, and just overall had a very strong partnership through time. Josh, I don't know if there's any other specifics you want to call out on Adam Street. I mean, I know I touched on kind of the key difference between HarborVest is really that size focused, and I think that makes this a good complement to what you already have in the portfolio. But any other, key comments that I missed?
I mean, that was the big focus on diversifying away from HarborVest is a key outcome that we're hoping for with the implementation on this capital call, right? Capital call, the commitment. Obviously, the large commitments made in 21, 2, and 3 to HarborVest, the only commitments in the OPEB being to HarborVest. So finding some diversification around the HarborVest exposures. Maybe one other question, just relative to, BlackRock's private equity research in general. We focused on we focused in on Adam Street. Is there, anything relative to the broader fund-to-fund landscape that we like Adam Street for, relative to kind of the broader market? I mean, I think, when we talked about this last month, we brought forth, the big choice that that we typically see in this space when we're working with clients is HarborVest and Adam Street. From what we highly recommend with the heavy HarborVest allocation, the Adam Street makes a lot of sense. Is there anything that we find that other competitors that Adam Street just does better than other competitors as well, or is there things that
I think like the focus of the business allows them to really generate top tier results. So, other names that play in the same space, Hamilton Lane, Stepstone, they have a little bit more of a consulting model where they're doing a lot more kind of portfolio completion for alternatives portfolios, which, is a necessary service, but it's a slightly different focus than Adam Street, who all they are doing is going out and finding the best private equity opportunities in their commingled vehicles. The Stepstones and Hamilton Lanes, which have a little bit more of a consultant organized business, that's a little bit more bespoke client by client. You just can't be as, prescriptive out in the market as what you're looking for, because oftentimes it's different depending on which client book you're solving for at the moment. And so we really like the specialization and the focus of Adam Street's business, because it allows them to just be kind of that much deeper in the market, because they know what they're looking for kind of every time they go out into the market. They're solving for kind of the same problem.
Josh and Carolyn, Josh, I think in the past you had recommended maybe BlackRock's fund-to-fund product. Did you guys consider any BlackRock funds before you even?
So I'll say from the BMR perspective, we consider them kind of like an extension of our team. So I don't cover them explicitly, because oftentimes in OCIO, we will partner with them in some client portfolios in those kind of completion type mandates that I was talking about in the Stepstone and Hamilton Lane case. So we do partner with them in certain client portfolios where it makes sense. But I don't have a view on them the way I would a third party, just because that team in particular is really an extension of our OCIO team to a large extent. Josh, I don't know if you have other comments.
Yeah, and this group has met Annie and Kyle from our private equity team. The product strategists for our private equity team, very deep knowledge of private equity and the funds that BlackRock runs. I think one of the differences between the Adams Street, the Harbor Vest, and what the BlackRock fund complex would look like is BlackRock's fund complex is a bit more modular. So it's not a single fund of fund. They have a primaries, a secondaries, a co-investment. They have a growth equity fund, and you can kind of mix and match as they fit. We like to use the BlackRock or recommend to clients the BlackRock private equity vehicles when we're looking to solve, maybe you need secondaries and co-investment and not primaries, for example. We brought to you, right, the OPEB theoretically could have just made a co-investment allocation. You could have looked at the BlackRock co-investment for the size of the allocation. It made more sense for the OPEB to look at a fund-to-fund approach. But that's usually how we look at the BlackRock private equity, kind of mixes and matches a couple of the modules together to build out and kind of complete that private equity program. I think, again, for the OPEB, given the size and the size of the commitments that you need to make, having a single fund-to-fund that's going to allocate across the spectrum and not be selecting the 2026 vintage of primaries, or it just makes more sense from a fund-to-fund approach.
Yeah, it's a little bit cleaner.
Okay. Are there any other questions around the table, or any of our members who are on the phone or Zoom? Okay.
Is it a quarterly subscription? But what is the?
No, this fund raises annually, and they will have usually 4 closes, 1 a quarter, and then it will be closed, and then draw down typically over 1 to 2 years, and then start paying out capital. But it is like an annual drawdown fund. Fund series, so it'll hold 4 closes over the course of the year. Josh, I don't know if there's a conversation to be had around waiting for the 2027 vintage so you get the early closer discount if you do a January close. I guess like the things to weigh there are 2026, you have visibility into what's in the portfolio. So that's a benefit, but waiting for 2027, you take the blind pool risk, but you get the discount up front, the early close discount. So I guess it's a point of preference because frankly, we have confidence in the platform regardless of kind of the blind pool risk. So Josh, I don't know if you have a preference on that.
So we walked through the pacing model last month. It's in this deck on, I think it's page 21, I believe. Yes, 21. But basically, what the OPEB is looking at, just given the size of the Harbor Vest commitments, we've seen a pickup in some of their capital calls, but the expectation is you're not hitting that 10% SAA target with just the Harbor Vest allocations as distributions come and we fund some of those capital calls. So we had recommended kind of an every other year commitment pacing timeline. So certainly making the commitment now, you're going to get invested. They already have some investments. I'm sure that there will be an early capital call here to bump the NAV, get invested, and generate those returns. If we wait 6 months, that becomes a 2027 commitment. You can get in early. Obviously, the commitment can happen in January or February and be invested for the year. That would push this schedule out. I'd probably think that 2028 commitment becomes a 2029 commitment. I think this every other year for the OPEB, just given no benefit payments come out of it, so the assets just grow, means that we're going to have to be watching what is happening to the rest of the NAV and how do we keep pace with the public market growth to allocate and keep that 10% target. I think that's where we're at. I don't know if waiting to save is, certainly it's dollars in, right? I think the early savers is what, 5 basis points on the 5 basis points or 5 basis points on the management fee. So that certainly is dollars saved to wait 6 months versus potential return over the next couple of months / being fully invested entering into 2027 or throughout 2027 and 2028 rather than deferring it another year.
Just to be clear, 5 basis points per annum or upfront?
Per annum.
That's 10% of the management fee. That's pretty significant. So on the blind fund side, it sounds like if we got into 27, it would be totally blind, and then if we got into 26, it would be, what, 50% disclosed or something?
Yeah. The portfolio at this point, probably 60%. Yeah. Committed, not called, obviously. So you could see probably 60% of the commitments, but those funds will still be calling capital, so it won't be. You'll only be partially called on some of that.
Correct me if I'm wrong here, but I mean, whether or not it's blind or they've already made some decisions, I mean, it's irrelevant to us. We're not granular like that as investors, right? We don't have the faintest idea. There's a element of trust here, right, between BlackRock and also this organization that we're going to be committing our capital to. I don't think. I mean, we may choose to want the discount. We may choose to want to slow pedal it a bit because some people on the board want to look over the paperwork. That's all reasonable. Yeah. But I don't think there's any reason to consider to be any kind of advantage to theoretically knowing, some of the investments that have already been committed. I mean, it'd be like going to a good restaurant and, asking the chef to tell us about all the different ingredients, and all we care about is the dish that we're getting right on the plate. Nick, do you have an opinion on that? Nick?
I mean, I think we made my opinion clear last time. I agree that we should, not waste time, and we should make the allocation if we think that we should be on this 2-year pacing schedule. So we are invested in the long run, saving 5 basis points on a fee that could be eaten up in half a year's of performance. It's possible. 50 bips over index versus what we're invested. And then, I agree with you as well on the fact that knowing what's in the portfolio, is that going to change our decision? Unless Josh or Caroline's like, oh, I've seen what's in the portfolio, we should definitely wait. I think we should just kind of get to it.
So we're looking at October 1 then for a subscription? Is that the next?
Yeah, I will check on the exact closing date. It's either October 1 or end of October. I just can't recall off the top of my head, but I'll get the exact closing date that we're working towards.
What is the actual? So paperwork would go to Tom Harris, our CFO, and
28. Look at page 20.
Thank you. Okay.
Kind of sets forth what's going to happen.
Yes.
I apologize.
Yeah, the next set. So obviously the offering memo we can certainly share, but there's going to be AML KYC requirements for Adam Street. We've certainly done that with our authorized signers. Tom is one of those. So we've already done our AML KYC, but Adam Street will need to do their own, reviewing the subdocs in the offering letter, and then working to finalize that subscription documentation. Not on the call with me today, but he's at least been in contact probably with Tom back and forth. Is Miles Ojala's on our team, on our operations team, that helps with working through all of the subscriptions, working through the documentation, and coordinating with Adam Street on that end. So you have a partner in BlackRock in doing all of this as well. But it's really just reviewing, preparing documentation, submitting that to Adam Street, and then making the funds available, which BlackRock manages all of the capital calls. So as any commitments get called, we have that, we work through that just as we do with HarborVest and all of your legacy managers.
I see in phase 1 and phase 2, there's references to drafting any IMA and guideline amendments.
Yep. I don't suspect that there will be any, but certainly if there's maybe a rep that Adam Street has that, we haven't already made in our contract, we'll just make a brief update, but there's no changes to our asset allocation, so that's not going to need to change. I suspect that there might be minimal, if any, changes at all to the IMA. This is just in there for covering if we do need to, if something comes up in the Adam Street subdocs or something with Wilmington that we need to adjust our IMA slightly to accommodate, we can make those edits.
So just on the review of subscription documents, the offering memorandum would have been part of that anyway, is that right? So we are getting that, okay.
Yeah.
And Caroline mentioned an Excel spreadsheet, I think, with the projected or the actual expenses at the different levels. Is that part of the IMA guideline discussion or provision of information?
So there's no change to the Excel file is strictly the Adam Street fees. What does Adam Street charge? What are the underlying fees? And what is the net kind of fee experience for you? There's no change. BlackRock's fee doesn't change for.
Sorry, I didn't mean BlackRock. If I said BlackRock, that's a mistake. I'm focused on Adam Street. So I think what the issue there was, there's a range of fees that we would be paid. It sounds like 53 is the outcome. And then there's their GP fees under that. And I just think for Board of Finance, Board of Select Persons purposes, we should be aware of what those fees are, just to be prepared to answer questions if we're asked.
Yep, I can share with Josh the spreadsheet that gives kind of the transparency on the breakdown of those fees.
Thank you. So just to be clear, management, incentive, is that right? The fund of funds has 2 layers of fees, and the GPs have two layers of fees as well. Is that right? Was that too simplistic?
It depends on, so like the buyout portion, this is why I want to share the spreadsheet with you, because it is convoluted. But the buyout portion, for example, doesn't actually have an incentive fee attached to it. But what they quote to you is the blended incentive fee, taking into consideration that there is no buyout incentive, and like the nuances between, they charge slightly different rates on co-invest versus secondary. So what they do is they have a spreadsheet that basically boils that all down to like a single number for you. So you know what like the all-in fee is, as opposed to trying to figure out what all those little pieces add up to.
Okay. I think until we see it, it's going to be hard to understand. So we'll see it and digest.
Yeah, and I'm happy to take questions on it, because even when you see it, it's a little convoluted. So happy to, Josh knows where to find me if there's more detailed questions around that.
Are there any other questions around the table or on the screen? Josh, anything else you want to add?
No, I mean, I hope that this was helpful and that, you all were able to get questions and answers directly from our manager research sources. In terms of, next steps, we can work with Tom. We'll send, across the subscription docs and the offering memo. And, we're obviously available by email, by phone, if there's questions from the group. Caroline, I think will follow up with the deadline, which is either October 1st or October 31st. So we know that we have to work towards that time frame. So we'll be cognizant of that as well.
Is this a voting issue? I don't think so.
I think just information to be received.
Right. Okay.
Yeah.
No. No.
Okay. Anything else?
Just here, consider and act upon.
Oh, the key word is act upon.
Act upon. This was, because we were,
Right,
didn't
Right.
want to act last month. So
Right.
we're having this
right. So I think we
meeting to
do
act.
need to take a vote to codify the decision to
Forward, yeah.
move forward with BlackRock's recommendations as stated, involving the
Subject
Adams.
to anything
Yeah,
that
the
we
Adams
see
Street,
that
right.
needs, right.
Does anybody want to make a motion?
I'll move to support the
BlackRock.
decision for BlackRock, putting us in the Adams Street investment for the vintage 2026.
Second.
Okay, second. Any further comments or questions? Do we want, before we vote, Tom made a specific motion. Do we want to make it a little less strict on the date? If there's some paperwork delays or something that push us into the beginning of next year? You want to amend the way you phrased that?
26 or 27?
Okay. Does that sound okay, Josh?
Yeah.
Okay. All in favor? Aye?
Aye.
Opposed? Abstentions? Okay, passed unanimously. Okay, we really do appreciate it. So I think there are some people on the board who would like to take a look at these documents that, and also this spreadsheet with the fees. And Tom is right. We do appear before the Board of Finance and the RTM once a year, and you never know what questions you're going to get, actually. Probably won't get these detailed questions, but we might. So it'd be good to have a little more
You
information.
weren't there, but I got a question once on the maturity of, on the tenor of the underlying investments in the HarborVest Fund of Funds portfolio. And I had to say, I don't know.
You texted me.
I did text you about that?
Right.
Okay, all right.
Yeah, I punted after that. Okay.
It's good to hear it's all laid
Yeah,
out.
absolutely. But listen, at the end of the day, and this is both a compliment and obvious, we wouldn't be having BlackRock as our advisor and paying the fees we're paying if all we were doing was, an S&P 500 index fund and, a total bond market fund. We're choosing to have a somewhat more complex portfolio. And this is where we're really leaning on you guys to steer us, because most people on the board, even those of us who are in the business, don't really have the kind of knowledge and access that you guys do. So, at some point, we appreciate all the info, but we are also going to put our trust in your judgment. Not to make it too much responsibility, but.
We've gladly accepted that responsibility, Ken.
Got it. Okay. Well, I don't think there's anything else on the agenda, is there? I lost it. Anybody have an agenda in front of them? I'm
Old
sorry.
business. Old business.
Yeah, old business or new business, either. Well, let's leave aside new business. Any old business? Okay, I'll take that as a no. Anybody want to make a motion to adjourn?
Move to adjourn.
Tom?
A second.
Eric? All in favor? Aye? Thanks very much, everybody.
Thank you.
Yep.
Nice to meet
Thank
you
you.
all.